Good day. I'm John Levy of John B. Levy & Company. Welcome back to our continuing series of podcasts on the commercial real estate equity and debt markets. We'd like to say that the market for commercial real estate equity and debt materially improved over the summer, but it didn't. Sales, which generally lead to equity and debt transactions, are still dismal. For example, according to RCA data, sales for the first half of 2009 are down 93% from the first half of 2007. And frankly, the 2008 versus 2009 comparison is not a whole lot better. Sales for the first half of 2009 are down 78% from the pace in 2008. Moving to the public sector, the TARP program is one of the many government alphabet soup programs that you've heard about. And this one is meant to funnel equity to commercial banks. Frankly, it's garnered lots of positive press, as more than 30 banks have already paid back their investments to the Treasury. Interestingly, though, and not nearly as well publicized, more than 20 banks have already stopped paying their dividend. What makes this particularly interesting is that these are the same banks that were deemed healthy less than 9 months ago. Unfortunately, this looks like a growth industry to us, and it's surely not a positive trend, as banks that cannot pay their preferred dividend to the U.S. Treasury are surely not looking for new commercial real estate loans. Luckily, the news isn't all bleak. Life insurance companies are on the hunt for new deals, and our July commitment volume, as shown in our proprietary data, shows a slow upward climb, July commitments being at more than $800 million. Which is the best in a number of months and the second highest in the last 12 months. For sure, it's nowhere near the levels reached in 2007, when volume on a monthly basis was in the range of $3.5 to $4.5 billion per month. Over on the CMBS side of the ledger, most maturity defaults are being handled with an extend and pretend philosophy, or for those with a religious bent, delay and pray. Servicers really don't want to foreclose, so short-term extensions are the order of the day, most being in the 1-year range. For developers seeking opportunistic money, there are a seemingly limitless number of sources, including our own proprietary funds. Many developers are trying to raise blind pools, money used to raise as yet unspecified assets. For the most part, we think they're on exactly the wrong track. There's virtually no blind pool interest from established capital sources, but they will respond quickly to specific, sophisticated, well-thought-out transactions. We hope you've enjoyed this podcast, and as always, welcome your comments. Please feel free to email us at jlevy@jblevyco.com or to call at 804-644-2000, extension 237. We thank you for watching.